So welcome everybody. It's time for a little stock and option webinar. I do like talking about this. I talk about currencies and futures and golds and silver and all that stuff quite a bit, and I love talking about some stock and option action. Sometimes I don't, sometimes I do, but right now I'm feeling pretty good about it. So we have some good things to discuss. If you hear noise in the background, we have a wild animal running around and apparently the end of the world as well. I'm in a small town. Why would there even be a siren anywhere? I don't know. Anyway, that is just fine. Okay, so I think everyone's saying yes because the screen is good and the audio is good. Is that good? Is that good? Everything all right? Just double check on that. Okay, good to see you, Peggy. Glad you made it in. Okay, guys, we're going to talk a little bit about what we talked about last week, and a little bit more along those lines, right? So we want to discuss. We've been talking a lot about selling naked puts and the benefit to that if your account can swing it. So selling naked puts is awesome. I love doing that. Has anybody taken a trade like that in the last week or so? Anyone sold a naked put on anything? And is anybody kind of planning on potentially getting assigned the stock? Anyone? Lenny, good. May I ask what the stock was? What did you sell a naked put on? If I know you, Lenny, it was probably Tesla. But if you were planning on getting assigned, it probably wasn't Tesla. Okay, Tesla, good. I love Tesla, man. That one that's the best one to sell naked puts on because you can always be $300 or $400 or $500 away and still make some okay cash. $850. All right, good. Okay, so let's talk about how we can do this in kind of a fun, good, happy, healthy way. Let's go to our stock screener. For those that are interested in potentially selling naked puts on stocks that you can afford, just use this guy right here, and you can change the price. I think I've shared this with you guys in the past. This is my stock screener. I will copy and paste it again for anybody that wants that. That's just free. Everything's there. You'll get some pop-up ads, but it's great. So you can look at that screener right there for some possible options you can sell naked puts on. So there's that, and that's always good. But what I want to talk a little bit about is how we can kind of combine a couple of strategies into one, right? So put a few strategies into one, and that is done by the following. Okay, good, Lenny. Good. We'll look at that. So you can get a lot of great ideas from this one. There's a few filters you can work on. Number one, price. So if you want to say, okay, I want to sell some naked puts, and I'm okay being assigned the stock. We'll talk a little bit more about that for just a moment to refresh anybody that's not clear on that. You have to think about the fact that if you get assigned stock, you're looking at least 100 shares, right? If you sell one naked put on one stock, one contract, you're potentially on the hook for 100 shares. So some of you might say, well, I'd rather keep that at stock under $20 or stock under $30. So you can, kind of filter through that. If I go to stock under $30 with this filter, now I go from 400 and whatever to 51. So there's 51 stock that meets that criteria. So now these are all interesting ones. These are all high volume, pretty active, stocks that we would be okay owning. And of course, you can filter that down even more. Under $20, how much does that narrow it down to 24? So there's about half as many. So that's good. And remember, selling a naked put, for anybody that's not familiar with it, is just the simple act of selling a naked put, right? And we're looking at, now I don't use this platform like ever, so I'm going to be terrible at this. But let's say that we're looking at whatever we're looking at, right? Vixie, we've got Vixie on here. We've got, all these different things that we can watch. But if we're going to sell a naked put, we can go over here to our, I wish I could make this thing go the other way around. That would be just great. I always use the higher prices higher and the lower prices lower because that makes sense in my brain. But let's say we sell a naked put. We're looking at VIXI, but let's look at as Lenny brought up. Let's look at key. I don't know how that happened. There we go. So let's look at Key. We can look at, so this is Key Bank, Key Corp, all that. It's just, you know, one of the big banks here. So these guys are trading at 11 bucks, right? I'm on a pretty short-term chart here. So trading at $11, but, you know, coming down, this is a big long-term weekly chart. You know, coronavirus sell-off was about 750 over here, and they're trading about 11 bucks. You know, I would say that the comfort zone here is probably in the high teens, low 20s, and here we are at 11 bucks. So if we see that happening, then we can say, well, maybe this is a stock I'm okay owning, right? The banking stocks are getting hit a little bit right now, but I think that's okay. Let's let them kind of drop a hair. They all look the same, by the way, so I can just pull up any chart. We can look at Bank of America. We can look at most of the airline stocks look exactly like this as well. So, you know, we've had this big drop, and then we're kind of just, you know, doing that type of business there. So we see that happening quite a bit. But if we're selling a naked put, just as a little reminder here, let's say, well, let's go back over here and look. So if we're looking at Key and we say, you know, let's go 15, 20, 22 days out, somewhere in kind of that vicinity. Let's say we go, well, let's say we go 15 days out. So here's 15 days of oops, there we go. And okay, so there is 15 days, and let's say that we sell a put on Key for, say, 11 bucks, right? And they're saying, okay, here we go. We're going to get $55 for that. Spread looks decent, right? 50 cent and 60 cent bid and ask. So our spread looks pretty good. So we should be able to get about 55 bucks for that. $55 per contract, 15-day expiration. Now, all that's telling us is if Key can stay above $11, right? Which is right there. So if Key stays above $11, then we just keep our 55 bucks per contract, right? Anything above $11, we keep our $55. Anything below $11, and we start going into a loss on the option. Now, when we're selling naked puts, remember, I don't really ever want to take a loss on the option. I want to just take the stock. I want to be assigned. I want the option to be exercised, and now I own the stock at 11 bucks, right? So they're saying, okay, you own the stock at $11, everything's great. But remember, we get to keep, either way, we get to keep that $55 credit. And so now our position, you know, we own Key at $11, but really we own it at about $10.45 because that $55 gets applied to the price of the stock. So we get $1,100 worth of stock for $1,045. That makes our break even really, you know, basically $10.50, right? So we could get out of that stock at $10.50. We could close it out at $10.50 just because we want to get out of it, we want to dump it, and we don't lose any money, right? So maybe we get into Key at $11.03, we get out at $10.50, and we lose $0. So that's the great thing about selling a put. Now, if we sell an option to get out, as we talked about, so this expires in 15 days below $11, we get exercised on the trade, and now we own Key with a break even of about $10.50, right? We'll just say for easy math, $10.50. Well, if we really want to get out of this thing, like this dropped to maybe $10 or maybe $9.50, and we're going, ooh, geez, that stinks. Then we can kind of look at this whole deal over here, and we can say, well, where does my break even really need to be, right? You know, how can I kind of just get out of this thing and be done with it? So what we can also look at is, well, maybe I'll sell a call to get out, right? But if you look on the call side of it, you know, we can also get about $55 for selling a call. So if you tack that $55 onto the $55 we received as a credit, now our break even really is about is just below $10. You guys with me so far? I know we talked about this last week. I just want to review it for just a moment. But $55 for selling the put at $11 strike price. We received $55. So our break even is really $11 or $10.45. And then we get another $55 for selling a call. So really our break even is another 55 cents below 10.45. So that's $9.95 or whatever, right? $9.90. So now our break even is just below $10. It's $9.90. So that's kind of our escape plan. If we sell a 15-day option to get in and we get exercise, we sell a 15-day option to get out. As long as the stock doesn't go crazy over a 1 month period, we have a pretty good safety cushion to get out around break even. That is, that's a whole dollar lower than where we got in. That's basically the stock dropping 10% and we're still at break even. So far, so good. Does everybody understand that? Does anybody not understand that? Because I'll move on if we're good, because I want to talk about a couple of things, but I want to make sure there's no rush. We have time. I don't want anybody to feel like you're holding up the group if you ask a question. So does everybody understand that general concept there? Everyone good? I love waiting in silence to see if anybody answers, and I'll wait. Everyone good with that? Does anybody need any further explanation? Any further explanation on that? Shooby-dooby-doo. Oh, okay, we got some stuff coming through. Yes, Peggy, selling a put to get in, selling a call to get out. Yep. Barbara, good. Okay, you're good. Hey, Janae, good to see you. Okay, Janae, good. Lenny, all right. And so selling a call, Amy, is just our exit strategy. So, and Brian, you're asking about, what price we sell on the call. It's going to depend on things, right? So if we got into this at 11, if we got assigned at $11 from selling an $11 put, and we get exercised on that, now we own $1,100 worth of stock plus our credit, or minus our credit actually. So now we own $1,100 worth of stock for $10.55. $10.45 or $1,055. Then it's going to depend. If we say, hey, I'm happy to be in this, number one. Number two, it's not tying up more of my account. I mean, we shouldn't take the trade in the first place if being assigned the stock is going to hurt our account. Not hurt our account, but put us in a situation where we can't take further trades, right? So that's the other thing that we have to kind of think about is don't take trades that you can't afford to be in and hold on to for a little while. So that's the other item there. So if we look at this, we say I like the stock and I can still take a bunch of trades and it's not going to hurt me. Then that being the case, what I explained earlier was we can sell a call. So we collect option premium when we sell a put, and we collect option premium when we sell a call. All that premium can be put towards lowering our break-even price if we're in a slightly panic situation and we just want to get out of the stock, right? We're just saying, I just want to get out of this. Then we find out what the option premium is. We do a little bit of math, and we'll sell that strike price on the call to exit at a place where the premium's enough to bring our break-even down. And it's, we've got to do the math, right? If that option premium, if we can get $50 from selling a call, we got $50 for selling a put to get in, so that brings our break even down 50 cents on the price of the stock. If we sell a 50-cent call to get out, and that brings our break even down another 50 cents. So we could sell, a strike price that is 50 cents or $50 lower than where we bought the stock. Does that make sense? I know it's a little bit crazy, but yes, it is step 2 after being assigned. Yes, and that's true, Janae. Yep, and we can always just sell a bunch of call options, and maybe never get taken out of it. Not never, but maybe not get taken out of it for a couple of strikes, a couple of expirations. I mean, so maybe we sell a call option 3 or 4 times, and the stock just kind of goes sideways and goes nowhere. And we keep that option premium over and over again. And that technically would bring our break even down as well if we're just trying to get out of the trade. So again, that's kind of our worst case scenario. If we're trying to get out of the trade, then we sell a call, we put that premium towards our break even, and we get assigned at $11, our break even's $10.50. We sell another option to bring our break even down to $10. And so then we're selling a $10 strike on key, for example, just to kind of get out of it. So yep. But or we just keep making money on it. Absolutely. So all those things are 100% true. Yes, exactly, Judy. Yep, we can just keep the stock and keep selling options on it. So that's kind of our worst case scenario. That's kind of how we get out of some of these trades if we're just tired of being in it and we just want to be out. But most of the time, I want to get assigned on these trades and I want to hold the stock for a couple of expirations of maybe some short-term call options. So if I'm saying, man, just get, the stock is stable, it's not moving around a ton, and I just can keep selling call options, maybe 2 or 3 strikes away from the current stock price, then I can end up making a bunch of money on the stock and eventually, easily hold it long enough to get, hopefully a nice run out of it. And maybe I've sold call options on that stock 3 or 4 times, right? And so I end up making a pretty decent, steady amount of money. I want everyone to kind of think in terms of, I have zero interest of trying to preach any kind of get rich scheme here, because this is just a good, steady way to make safe profits and safe income. So I love this. But that's not all of what I wanted to talk about today. That's kind of the foundation of where I want to go with this. So is everybody pretty good on all that? Everyone feeling good, seeming good? Does that all make sense pretty well? Sell a put to get in, sell a call to get out. And we're going to determine where that call strike price to exit the stock is, depending on A, how bad we want to get out of the trade, and B, how the stock's doing. If we're happy to be in the trade and the stock seems to be doing well, then we're just going to keep selling strike prices on call options to get out that are maybe 1 strike or 2 strikes above the current stock price, right? And so that is, that's how we're going to be doing that. Yes, so we get in through selling a naked put, and we get out through basically selling a covered call, writing a covered call. Yep. Absolutely. So it's a covered call strategy. So that's 2 things, right? That's selling a put to get in, selling a call to get out, and that's a covered call to exit. So covered calls is a whole strategy, number 1. But what I want to talk a little bit about today is doing this in a little bit of a safer fashion, right? If you look at whatever stock is interesting looking at the moment, right? Maybe it's a stock that you feel like, we've talked about Delta a lot. The airlines are down a bit. We've just read that United's going to lay off. What was the news? United is going to lay off like 35,000 people or something like that, right? United could furlough, that's my favorite word, 36,000 workers as virus cases soar, right? So they're just gonna go for it. So that'll probably hit the airline stocks a little bit, but I still like all the airline stocks. I think Delta is a great one. I think United is, terrible, and I just don't like those guys at all. So I don't want to buy stocks that I kind of hate. But I think Delta will do well. I think some of these airline stocks are going to do fine. I think some of these banking stocks are going to do fine. So, but what I want to kind of suggest that everybody look at here is, here's Delta, right? And we say, okay, I'm excited about selling a put here. And we can do pretty well selling a put on Delta, right? If we go over here and we say, okay, let's sell maybe a 15-day expiration on Delta. So Delta's trading at about $25.50-ish. If we sell a $25 put with a 15-day expiration, that pays us 163 bucks, and it's a pretty good spread, 160 and 166. So that's a good spread. That's easy to get into, and that pays us $163. So if we get assigned Delta at 25 bucks, we actually really get assigned Delta at about 23, 40, 35, 40-ish area, right? Because we get to apply that $163 towards that $2,500 worth of stock that we own. So now our break even is, somewhere between $23 and $24. But you might think, what if Delta drops? What if Delta goes from 25 bucks right here? It goes from $25 down to $17, right? We go back down to kind of coronavirus lows here. And we're thinking, yeah, that stinks. Well, then the other strategy that we could do with this that I kind of like a lot is as follows. You guys ready for this? This might sound like crazy talk, and if it doesn't, I would be decently disappointed. So here is here's kind of the scenario. What we can do is we can say, I'm going to start this trade out as a credit spread, right? Because then we can take a whole bunch less risk. So if I start this out as a credit spread, let's go back over here. Again, I'm fumbling my way around because I don't ever use, this platform is surprisingly crazy different from the web-based platform. And I like this one because it's real easy to use, or I like the web-based because it's real easy to use, but I probably should get used to using this one, but I haven't. Okay, so we sell a put spread, right? So we're gonna sell the $25 strike and we're going to buy the $24 put strike, right? So this right here is gonna tell us, okay, if we do that 15 days out, and again, this is like upside down to me because I just don't ever look at it like this. But we do that, they're gonna say, okay, max profit and max loss is, and this is all in a different place here. How do we, okay, there we go. It's all in a different spot, but we're gonna say max, okay, so our max profit is $66 and our max loss is $34, right? That's pretty good. We'll risk 34 bucks if this goes south. So what it gives us the flexibility to do, we already know we can get $166 for this put if things, you know, if we get assigned, right? About 165, 160 some bucks for that put. But if we turn it into a credit spread, we just get $66. So what that tells us here is we sell a 25 and we buy a 24 like that. And here's what we can do. So we as a credit spread, we get $66 here. $66 profit if this ends up above $25. So that's great. If it ends up below, we can do one of two things here. And this is where it gets kind of fun and kind of exciting. We can do one of two things. We can say, well, I'll take my $34 loss down here. $34 loss below strikes, and just be done with the trade, right? Maybe the airline stocks, maybe we're in this trade and the airline stocks just get hammered. They just get killed, right? And we go, I'm just gonna take the $34 loss. That's fine. But what if Delta does this? And this happens on the regular. What if Delta does this? It goes down here and then it just kind of starts floundering, right? And it's just below there. And let's say that our long strike, this guy right here, our $24 put, our long put, let's say that position is in profit 10 bucks, right? It's not really going much of anywhere. It's break even. It's $5 up. It's $10 up. We're nearing our expiration. We can just say, you know what? I'm going to sell this option right here. I'm going to close that lower position out. I'm going to sell my long put and get out of that. And just get out at break even, maybe a $5 loss, maybe a $5 gain, whatever. Even if it's down a little bit, right? Maybe it's down here and we're in the $22 range and we say, I'm still okay with that. And our long put is in profit, say 50 bucks. I'm gonna take that $50 and keep it and apply it towards my strikes. And I'm gonna let this short put expire and get exercised, right? So I'm gonna close half of this trade off saying, I know that I'm applying some of the profit from that lower buy to open put towards my stock price. I'm gonna let myself get assigned. I'm gonna get all that $166. I'm gonna apply that towards my stock price. And now I've got a scenario of, break even's even a little bit lower. And I started off with a credit spread, which is a very nice little way to really limit that risk, because in the beginning, my risk was only 34 bucks. But if the stock seems to be doing well and the airline stocks seem to be doing well, I might close out my long put and get out at break even or a small loss or a small profit and let that short put, my $25 sell to open, exercise and assign me the stock and keep that credit. Does that make sense? Everybody good with that? So we can start this off with really minimal risk. And again, if the airlines just take a dump, right? They just go right through the floor and the airline stocks or the banking stocks or whatever it is we're looking at just drops down and disappears. Then we just let, yeah, Peggy, you've experienced some of that. Coronavirus sell-off, good times. We let that happen, right? And we just say, I'm gonna take my $34 loss. That way I'm not tied up in you know, 1 or 2 or 3 or 400 shares of stock, and it's way in drawdown, and I got to sit on this thing forever. I just let these expire, take the max loss of 34 bucks, and I'm out. But if going near expiration, the stock is maybe just a little bit below my strikes, I can turn that into a nice little naked put situation. As long as it doesn't make sense if my long put is in a big loss, right? My long put's maybe down 100 bucks, then that's not going to work out. But I've had so many situations where I've done this because my long put, my buy to open down here was $10 in profit, you know, $8 in profit, $5 in profit. It's just basically sitting at break even. So then I close, I sell that buy to open put, and I'm just leaving my sell to open put, my $25 one. And that way I can start with that really low risk. If everything looks steady and stable, I can turn that credit spread into a naked put, get assigned the stock, turn it into a covered call opportunity. Probably a tangled way to do it, but it's a way to really give yourself a buffer. The thing that we have to do in the stock market as much as possible, you know, yes, there's a lot of stocks that are going up right now. We've seen the big post-coronavirus, you know, situation really take off, and everybody's going, what in the world is happening here? But oh, hey, there we go. But if we look at that situation in just a normal scenario of, you know, picking direction on stocks is tough, and that's why I love to sell puts, and that's why I love to trade credit spreads, is because trying to get a good steady direction on these stocks is really tricky. There are excellent stock pickers out there. I don't know that I'm one of them, but I know how to finagle the market enough to give us some pretty good opportunities to you know, give us a big cushion and give us some wiggle room so that we can work our way out of a position with some nice little profits. And, you know, it takes a lot of risk out of this, and that's the name of this game, right? Is staying low risk and giving yourself a lot of padding, right? And not trying to figure out the direction too terribly often. Because if we do want to figure out the direction, you know, a lot, then just constantly sell 90-day expiration credit spreads, because everything over the next 90 days is probably going to be a little higher than it is today. So there you go. Oh, Tastyworks back up. Okay, I like it. So sorry guys, breathe. So anyway, does that make sense to everybody? You guys all very okay with the details? Andrew, nice to see you, my friend. I have a question on selling covered calls. If it closes in the money at expiration, is your loss just the obligation to sell your existing shares? Yes, Andrew, that's correct. Yep. If you write a covered call, you know, you own the stock, you sell the option. If you sell a $25 strike price and you own the stock at $24 and the stock runs up to $26, your option you sold will show a loss, but there's no loss to be had. That's just, if you want to hold on to the shares, that's the loss you would have to take to keep those shares. But otherwise, you keep the option premium and you're obligated to sell the shares of stock at the strike price of that option you sold. Does that make sense? Does that answer your question? Is that good and clear? Yeah. Okay, so does everybody feel like they understand how to trade a credit spread, turn it into a naked put, get exercised, sell an option, write a covered call as we call it, to exit? Does that sound pretty good and clear for everybody? You guys feeling okay about that? Who has questions? Who has some thoughts? Who needs some details answered? Good. So find a stock you like. You know, I'm pretty bullish most things right now. There's a few that I think are overextended. We've talked about Apple and Tesla that just keep going through the roof and going crazy. And somebody, I was talking with a few people this week about stocks like AMD, right? AMD's an interesting one that has just gone bananas. I know a couple of people that are in AMD right now. This one is just going crazy. Speaking of going crazy, I've got a dog that's going crazy. So everyone should get a puppy. So AMD is, and old Shopify, AMD is an interesting one, right? Because we've had this big move up. Where do I think AMD is going to go in the future? I think they're going to go straight up, right? But in the meantime, we have a pretty nice little, pretty nice channel, or actually more of a bit of a pattern here. You can see that, this stock is kind of doing this. We've kind of got this little scenario here. So we could see AMD break above 59, 60 bucks. I think that's going to happen. That would be a great opportunity to sell a put, right? And on that breakout, sell a put. You might just end up with the option premium. If it ends up pulling back and giving us kind of a false break, we might own some stock and take it away. But a stock like this, good situation, good scenario to be looking at that premium, right? If you own some AMD, how could we, not that I would get in right now, right? Because this is just on a crazy spike higher. But in this kind of area, maybe we see this thing break out, pull back, retest, and we want to sell a put on that. We can definitely do that. And so we start that off as selling a put or just trading a credit spread. Strike prices on AMD are only $1 apart. So you get a $50 credit, take a $50 risk, you're in good shape. If the stock ends up just tanking and going nuts, you take a $50 loss, and that's just fine. But if it ends up, kind of floundering around that area, maybe we can turn it into a naked put, get exercised, keep that credit, apply it towards our break even, and start selling some options on it to get out. So that's the kind of thing that I want to be looking for here with something like AMD or anything else. Okay, so questions. Okay, would it be wise to roll up on a stock like AMD if you're in the money and expiration is tomorrow? Should have never put the covered call on this one. My strike was 55. That's okay. Find out, Andrew, some of these stocks are going to run away. Some of them aren't going to run away. I am not a fan of rolling a position and realizing the loss on a covered call. Take it, be done with it, take your profit. If your strike is $55, hopefully you own it for less than $55, and just take that profit and look for another opportunity to get back into AMD. So no, I wouldn't say roll the position. I would definitely not say to roll the position. Okay, good. Lenny, yeah, Shopify. Some of these tech stocks have just gone so crazy. Shopify, another just big monster of a, ultra extended. I mean, it was not that long ago. In fact, it was coronavirus sell-off that Shopify hit, $300. Here it is at $1,040. I mean, it's nuts. It's nuts. So at some point, there's going to be an opportunity to, to get a bearish trade here and see some of these things, make a nice little pullback. And we'll be watching for that, be watching and waiting and ready and so on. But it sure looks like the tech stocks are just going to rip for the foreseeable future. There's a ton of momentum behind this. Okay, let's look at CLOU. All right. Yeah, another one that's doing great, and a nice cheap stock as well. So 23 bucks could be a good candidate for selling a put and maybe owning the shares. But you don't want to do that at an all-time high. Remember, we're always looking for these trends and channels and support and resistance and reasons to get out or reasons to take an entry because something has pulled back, right? And so this one, since Corona Town got down to 12 bucks, it's up 100% in the last couple of months. So it's making a nice little move. Probably getting a little on the overcooked side. So we do want to wait for these things. We want to watch these channels and say, okay, how's that behaving? And how is that behaving? And just kind of let these guys, Apple's got the same channel. At some point, it's going to need to pull back, make a dip, come back down to some of these lower targets, and then just continue pushing higher. But it's a great way and a great opportunity to, use that strategy that we're talking about, which is sell some puts, sell some puts to get in, some calls to get out. Okay, how's everybody feeling about all of that? So far, so good? So yes, questions, comments. Hey, Andrew, just seems fundamentally like the sector is going to the moon. Yeah, it does seem like it. It does seem like it a little bit. So that's kind of, oh my gosh, you guys, don't get dogs. Stay away from dogs. I'm a moderate dog lover. I'm a dog tolerator most of the time, but when they make this much noise, I'm left to my office with 2 dogs that I have to keep an eye on, and of course they have to make the most amount of noise. Anyway, does that make sense to you guys? So I'm going to be posting a couple of trade recommendations along this strategy of starting off with a credit spread and kind of working our way through it that way. So start off with that credit spread, trade it into a naked put, get assigned some shares, sell some options to get out, send it over and over again, but we love it. Basic lessons on options somewhere. Yes, absolutely. I will. I'll post those details. Yep. I'll definitely. Tastyworks, the broker I use, has some really good stuff. And I'll post those videos for everyone. You guys can have a little peek at that because there's some very good stuff on option basics that will be super helpful for those that want to learn a little bit about it. We need to know how to sell options. We need to know how to buy options. We need to know about the futures and the currency markets. We need to know about all of it. Tastyworks is the platform too. Yep, I'll post all those details. I'll post all that in the chat as soon as I'm done. So yep. So this platform right here is Tastyworks. This is my favorite version of it. This is their downloaded version. It's cool once you get used to it, but I just don't use it much. I prefer the web-based platform. I feel like it's a little cleaner and easier to use. But yeah, that is exactly it. So Andrew, with selling covered calls in this environment, not really recommended because of bullish Fed environment. No, I wouldn't say that it's not recommended. I think selling, writing covered calls is always a good thing to do, because I don't think we're in, an endlessly rising market. I think we're in a nice uptrend. I think we're in a nice bullish trend, and so selling options, writing covered calls is a great way to keep the risk low and participate in, in the rising market. So the thing honestly I would say for nobody to do right now, don't buy calls and don't buy puts. Don't do that, because that's where everybody loses all their money. It's where you can make the most money if you're really tuned into the stock market and, it's and you've got a good feel for a certain stock, and a certain strategy that you've used works very well on getting those little pops in stocks, then great, buy some options. But for the most part, if you're putting a position on, letting it sit for a while, there's going to be the occasional option that you buy that does really well, and then most of them are going to just probably lose you money. So stick with credit spreads, stick with selling puts, stick with writing covered calls. That's going to be, a good, safe, profitable bet on all this. Okay, I think that's it for me. How do you guys feel about that? Does everyone feel kind of wrapped up in a bow? We are selling credit spreads, which then turn into a naked put, which then turn into owning the stock, which then turns into writing covered calls. So we're kind of using these 4 strategies to get us into a trade, low risk, get assigned some stock, own that stock, write a covered call to get out of that stock. I love it. I think it's a great way to go, and it's kind of the only thing I'd recommend doing right now. So it's the best thing that I've seen for just really, creating a nice padding for yourself, but also being able to kind of participate in the stock market. Now, it's going to happen from time to time that that we sell a credit spread and the stock just runs right up, and we just take that premium on that credit spread. That's fine. Or we get assigned the stock, and then the stock takes off before we can even sell an option on it. That's awesome. That'll happen too. And then there's going to be the time where you get a write covered calls multiple times on the same stock, right? The stock just is going nowhere, and you're just selling option after selling option after selling option. and you make 3 or 4 or 5 times as much as you would have if this would have just kind of been a one-step process. So that's why I love doing that. Okay. Andrew, when applying for opening an account with Tastyworks, do you get approval for options before depositing? Yeah, so basically what option approval will depend on, for anybody that's kind of interested in this, what option approval depends on is how much experience you tell them you have, right? They'll say, do you have extensive, limited, whatever the 3 options are, in stocks, futures, options, whatever. So if you tell them you have experience, you'll get immediate approval. If you tell them you have no experience, then they won't give you option approval. So, so that'll be something to look at. Don, they do not have paper trading. No. The other thing you have to do is, so they'll ask about what your experience is. If you put extensive experience, then that will give you option approval. And as well, if you put, you need to put that your goal is speculation. If you put long-term gains, they may or may not give you option approval. So you got to put speculative or speculation is kind of your goal. And yeah, so no paper trading with those guys, but we don't really believe in paper trading. We just go for it. We put a couple of bucks into a trading account and we go for it. So that's kind of the way to do it. But what you can do is, trade some really low risk credit spreads where you're maybe risking $50 and making $50, that kind of thing. So, yep, just do small trades. Peggy, they do have a practice account. Tastyworks has a practice account? That's news to me. I was unaware. I'll have to go back and check. I've never seen a practice account on Tastyworks. Really? I know they said they were going to put one in there, but that's great. It's great if they finally do. Do financial institutions share info with each other? Sometimes. I think sometimes they do. So now it depends on what way you're asking, right? If you're saying, are you asking about like your broker, one broker to the next? You can transfer broker accounts from, if you're with TD Ameritrade and you want to move over to Tastyworks, they will move their positions and you can transfer your whole account and your positions over. No, they don't share that information, Andrew. Nope, they do not. All right, you guys. Any other thoughts? Any other questions? There's a lot of good stocks out there to be trading. A lot of good situations that I'm getting kind of excited about. So use this stock screener. Look for stocks under $20 and or $30. And I still like the banking stocks. I think the banking stocks look good. The airline stocks look pretty much exactly like the banking stocks. They all kind of look the same, right? And that's great. That's great. These are all good stocks that I think we have a nice opportunity to jump in on. Thanks, Lenny. Nice to see you, my friend. Okay. Yep. Switch over to Tastyworks. Anybody want to switch over? Check the chat for the link. I'll post the link that you can use to open your Tastyworks account. All right, you guys. That's it. That's it. Yes. No dogs. No dogs. Don't get a dog. Nobody get a dog. All right, thank you guys. Nice to see everybody. That's it for me. Have a lovely Thursday evening. I'll get this recording posted and take it from there. Thanks, guys. Take care, everybody.